Gig economy stocks in focus this week after Lyft and DoorDash reported results. Uber also announcing its first ever stock buyback plan of up to $7 billion several days after reporting its first annual profit. Joining us right now is Michael Morton, MoffettNathanson's senior analyst. And Michael, what do you think? Is this the year of the gig economy stocks and people finally realizing or seeing that there's a path to profitability?
Yeah, I think you really hit the nail on the head. It's been a really impressive last 12 months for this industry. And it's the case of investors changing their perception on businesses that were thought to be bad and are turning out to be much better than they realized. And I mean, rightfully so. The industry, we estimate from 2015 until 2022, consumed $125 billion of investor capital. They're attacking gigantic addressable markets that we estimate $4 trillion. So there was a real emphasis to grow market share at all costs and not focus on profitability. And it gave them generally a bad reputation. Now, for Uber, they were forced to get disciplined during COVID and run a lean operation. And in the last year, you've seen DoorDash tighten the belt around expenses, and you've seen profitability explosion from DoorDash and Uber.
I mean, the amazing thing is that we used to think that consumers loved these businesses, but they loved these businesses because things were being given away, even when they're not at this point, and the prices are raised to the point of making it a profitable endeavor. People are so used to using these services. Maybe we've changed consumer behavior so much that there's no way they're going to live without them at this point.
Yeah, it's a really interesting way to view it. And I've heard people refer to Uber and DoorDash as the undeletable apps. And there's some guarantees in the world, very few, but one is that humans like to move around, right, and experience different things, and Uber is a benefit of that. And for decades, the U.S. consumer has spent more money year over year having food prepared for them than they did in the prior year. So again, there's no real guarantees in life other than death and taxes, but people's interest in traveling, exploring new places, and the desire to have people make more food for them than they did in the prior year are really consistent, and these companies are perfectly positioned for it.
Now, this is not a surprise to investor. If you've been watching these over the last 12 months, Uber shares up 124% over that time period, Dash shares up by 82%, and then you've got Lyft shares up by 67%. So we have seen buy-in on Wall Street. I guess the question at this point becomes, is there a risk factor here? How much has already been built into this, and how much room is left to run?
Yeah, we are buy-rated on Uber. We are neutral on DoorDash. We thought there was going to be some headwinds from student loans, but there appears to not be. The U.S. consumer enjoys spending money, and they're growing right through the student loan impact. These are really promising businesses with secular tailwinds. Like I said, people eat out more every year. They're growing frequency. And what's really interesting is that they're attacking new addressable markets. Instacart reported in the last week, and grocery is a $1 trillion category that's underpenetrated. So there is some risk, I would say, in the next year where management teams like DoorDash and Uber get more aggressive pursuing this opportunity. And years ago, restaurant delivery was thought to be a bad business. They showed you the unit economics around that work. We have a proof of concept for grocery. You can look at Instacart. You can see that they're profitable. You put advertising dollars on that business. So there might be some periods, what you're seeing, for example, the first half of the year with DoorDash. They're investing more aggressively. Margins aren't really in line with what investors had wanted to see for the first half, so the stock is trading down a little bit. That's some of the risk, right? They see opportunities and they pursue it a little more aggressively than Wall Street might have expected.
Is weather really an issue? I mean, DoorDash, we're looking at its stock down 7.5%. There was something in there Wall Street didn't like.
Yeah, we joked in our report that came out this morning. The track record of companies blaming weather for poor results in my career has not been great. Now, if there is a company that I want to give credit to for when they say weather is bad, it would be a food delivery service, because I'm sure you've been sitting at home, you thought you were going to go out to dinner, and all of a sudden it's pouring rain outside or it's snowing, and you look at your spouse and you're like, no, I think we're going to get food delivery. At that same time, the supply side of the marketplace, which is the drivers, you're less inclined. It's pouring, it's snowing, the roads are icy. You're less interested in driving tonight than you might have been if the weather was good. So costs escalate for DoorDash because they have to offer to pay the Dashers and along with Uber Eats more to get in the car, to get on the electric bike and go out in the bad weather.
Okay. I mean, that makes sense. It's a little counterintuitive, but I get it. Michael, let's talk a little bit, though, about the risk from regulatory oversight. You can look at this on a state-by-state basis, or you can look at what the Department of Labor is suggesting in terms of turning a lot of these contract employees into actual employees and what that would mean from the profitability standpoint for these companies. What's the biggest risk? What happens?
Yeah, we've always highlighted regulatory as one of the biggest unknowns for these companies. And even if you want to talk about it on a state-by-state basis, right, there's 50 states in which they operate. Uber operates in 70 countries, DoorDash at 27, 28 countries, Lyft just operates in the U.S. and Canada. It is absolutely a risk, and it's diverse around the world. The one aspect of this is that the companies have shown an ability to operate in different regulatory environments, right, globally and in the U.S., and different state rules. Some impact unit economics. You're seeing in Seattle the aspect of where there's a lot of unintended consequences to this regulation. And I think the politicians are starting to realize that as well. They pushed the fees through that they raised for consumers, and it's hurting both the affordability from the consumer side, and it's also hurting demand, which then makes it harder for gig economy employees to earn. DoorDash put out some interesting stats last night and they've spoken to this in the past, 90% of their Dashers work less than 10 hours a week. It's supplemental income for them. So I think it's important that the regulatory bodies around the world try to work with these companies because it's an important service for both the workers and consumers. But again, they've shown an ability to operate in a variety of regulatory environments.